When you look at Jay Powell's message, the markets have obviously in the U.S. responded very positively. But when you extend it out to the rest of the world, particularly emerging markets, what does this stance mean for them?
Well, emerging markets are very worried about what happened the last time the Fed tightened, which was, it began with the taper tantrum, which was an absolute disaster for some of them. So they recognize that at some point, policy in industrial countries has to get tighter, and the Fed leads the way. And what they would love to see is, when it happens slowly, that it's well advertised. There's a process by which, accommodation gets removed, and markets have enough time to react that it doesn't happen abruptly. So I think, to some extent, Chairman Powell did what they wanted on Friday by essentially laying out a path where first, they would spend some time looking at the strength of the labor market, then decide to slow down asset purchases. And when that ends, there would still be some time when they would assess whether markets, the economy was doing fine. And at that point, they would start raising interest rates, that there wasn't an immediate connection between when they ended asset purchases and when they started raising interest rates. So that bought a fair amount of time, both for the Fed to see what's happening and for emerging markets to react.
So how do you think this is going to play out? Is this the right path for the Fed? If we had a Fed official here, they'd say, well, we make policy for the U.S. But if you look at not only the U.S., but you look at the world more broadly, what does this mean?
Well, we're coming off a pretty substantial amount of accommodation. Remember, we didn't tighten really strongly after the global financial crisis, and we started the process of accommodation, in 2018. And of course, the pandemic brought a huge amount of monetary accommodation. So there is a lot of liquidity in markets, and some places are fraught. So what the emerging markets worry about is an abrupt change in stance. They don't mind a steady change in stance, but abruptness and a shocked market is what they fear. So what I think this has done, certainly for India, is given it some time to remove some of the liquidity in Indian markets and adjust for a world with tighter monetary policy. For China, too. China, of course, is in a different phase of the cycle right now. What is happening in China is, in a sense, the PBOC, the People's Bank of China, is trying to goose up the economy a little bit after it has seen some signs of slowing. So it's in a somewhat different phase, but China is much better protected, both because it runs a large current account surplus and it has tremendous amounts of reserves.
And at the same time, you see the Bank of Korea becoming the first major Asian economy to start the tightening process. We're pretty certain that the RBNZ will be next. Is this a really strong signal to central bankers around the world that the structural issues with each domestic economy are going to potentially trump the impact of the Delta variant?
Well, I think emerging markets have much less room to wait and watch, partly because they have less credibility, both on fiscal policy as well as on monetary policy. Also, some of them have actually stretched their fiscal quite a bit. Debt levels are, like in industrial countries, in some emerging markets, that they are at unprecedented levels. Some of these countries have, corporates that have borrowed in foreign currencies. So what they don't want to see is an abrupt change in financial market prices, including the exchange rate. So they want to prepare well in advance, sort of match the removal of accommodation, which is perhaps why you see some of them moving.
Okay.
Also, you see some of them experiencing inflation earlier. Food inflation hurts emerging markets much more because it's a bigger part of the food, the consumer basket. So they're also acting preemptively for that reason.
Let me get to India, and I want to throw up this chart taking a look at what we expect to be a base effect push when it comes to the GDP reading that we're expecting, given that 2020 was just such a horrible year. Clearly, we see some of the cushioning from a targeted approach to the pandemic in this set of numbers, right? But how far is there to go before we see the true kind of release of pent-up demand?
Well, I think there is some pent-up demand, but there's also a fair amount of scarring in the Indian economy, right? So the pent-up demand comes from upper middle class households that have saved, that haven't spent that much, and also from some of the supply constraints, as well as the lack of mobility, which has prevented spending. So that would result in some demand as the economy reopens fully. But there's also, lower middle class households, the people on the verge of poverty, as well as the small and medium enterprises that have not had the kind of support that industrial countries have been able to afford some of their people and their enterprises. And they have actually been hurt quite a bit by the pandemic. Some of them have stretched their borrowing. Households have mortgaged their gold to borrow. So these are going to be stressed entities, and their demand is going to be much more limited as we come out of the pandemic.
Raghu, is China a bigger force in the world in terms of what we worry about? China looks like it's managing its recovery pretty well. They will ease as much as they have to. If they slow down, what does that mean for the rest of the world? What does it mean for emerging markets, especially in the Asian region?
Well, China is moving or trying to move to a new model of growth, right? Where it relies less on fixed asset investment, less on exports, and more on catering to consumption demand domestically. And it's still halfway housed there. It's trying to move in that direction. And what you're seeing is after the surge in exports as China came out of the pandemic and other countries started importing, including protection equipment and so on. What we're seeing now is a slowdown in China. And the question is, can they get sustainable growth without relying on yet more fixed asset investment, yet more investment for exports? Can they move away from that model in a sustained way?
Okay.
Now, they're doing all this even as you're seeing some moves against the private sector in the interests of what they call common prosperity or more equitable growth. So they're trying to do a lot of things at the same time.
Yeah.
And the question is, are they trying to do too much?
They're very busy. One quick final question, though. What's the mistake you see the Fed making, perhaps, on inflation, on taper, whatever, that could really kind of throw things off, not just for the U.S., but globally?
I think the Fed thinks it has time, essentially because Chairman Powell, as he said on Friday, believes the medium-term forces that prevailed post global financial crisis, aging, automation, globalization, they will come back to keep inflation down. But there's one big difference post-pandemic, which is the enormous amount of fiscal spending. That wasn't there post-global financial crisis. And that may make the difference in regime between a regime of low inflation, which we had post-financial crisis, and a different regime post-pandemic. So my worry is if they don't fully account for these new forces, they may be behind the curve. And that may, as everyone says, necessitate stronger tightening down the line.